Imagine waking up every single month to a fresh deposit in your brokerage account. No work required, just pure, consistent income. For decades, dividend investors had to wait 3 months at a time for their payouts. But a new class of ETFs has changed the game entirely. These are the monthly paying income ETFs. Some offer yields as high as 12%, paid out like a regular paycheck. But how do they actually do it? How can a fund pay out so much cash without immediately going bust? Today, we pull back the curtain. To understand these funds, we first have to understand a specific strategy used by institutional pros for decades, the covered call. Step 1 is simple. The fund buys a basket of stocks like the ones in the S&P 500 or the NASDAQ 100. This is the cover. Step 2 is where the magic happens. The fund sells or writes call options against those stocks to other investors. In exchange for selling these options, the fund collects an upfront fee known as a premium. This is where your monthly payment comes from. But in finance, there's no such thing as a free lunch. By selling these calls, the fund is making a massive trade-off. If the stock market moons and prices skyrocket, the fund is capped. They have to sell their shares at a preset price, missing the rally. However, if the market stays flat or moves slightly up or down, the fund wins. They keep the stocks and the premium cash. Let's look at the fund that started the modern craze, the Global X NASDAQ 100 Covered Call ETF, known by its ticker QYLD. QYLD is a systematic machine. Every month, it buys the NASDAQ 100 and sells at-the-money call options on 100% of the portfolio. At-the-money means the strike price is set right at the current market value. This generates the absolute maximum amount of premium income. This is why QYLD often boasts headline yields of 11 to 12%. It's a cash flow beast, especially in flat markets. But there's a catch. Because it sells all its upside, the share price of QYLD has historically struggled to grow, often slowly losing value over time. Investors call this NAV erosion. You get your monthly check, but the underlying value of your investment might be shrinking. Recognizing these flaws, JP Morgan launched a different kind of animal in 2020, JEPI, the Equity Premium Income ETF. Unlike the systematic approach of QYLD, JEPI is actively managed. The managers don't just follow a script, they make choices. Instead of chasing volatile tech stocks, JEPI builds a defensive portfolio of low-volatility S&P 500 companies. But here is the real secret sauce. JEPI doesn't sell traditional options. It uses something called equity-linked notes, or ELNs. ELNs are custom-built instruments provided by major banks that mimic a covered call strategy but offer more flexibility. JEPI typically sells out-of-the-money calls. This means the strike price is higher than the current price, giving the fund room to grow. This leads to a lower yield, usually 7 to 9%, but much better protection when the market gets rocky. It's built for defense. In 2022, when the S&P 500 crashed 18%, JEPI held firm, losing significantly less while still paying out monthly. If you want that active management style but with NASDAQ tech growth, JP Morgan also offers JEPQ, the tech-focused sibling. JEPQ often yields more than JEPI because tech stocks are more volatile, which means their option premiums are more expensive. For these ETFs, volatility isn't a bug, it's the feature. The crazier the market gets, the more money they can collect from option buyers. But there's a new player in town that is catching the attention of high net worth investors, SPYI, the NEO's S&P 500 High Income ETF. Most monthly ETFs have a major weakness: taxes. Payouts from funds like JEPI are often taxed as ordinary income, which can be as high as 37%. SPYI uses a specific type of option called Section 1256 contracts. This sounds technical, but it's a game changer for your tax bill. Section 1256 contracts are taxed at a blend, 60% at long-term rates and 40% at short-term rates, regardless of how long you hold the fund. In a non-retirement account, this can mean keeping significantly more of your monthly paycheck after the IRS takes their cut. Now, we must talk about the biggest trap in the income world, the total return trap. High yield does not always mean high profit. Total return is your price appreciation plus your dividends. If a fund yields 12%, but the share price drops 15%, you are actually losing money. In a roaring bull market, these ETFs will almost always lag behind. When the S&P 500 goes up 30%, a covered call fund might only go up 10%. This is the opportunity cost of income. You are trading your future growth for cash right now. It's a choice every investor must make. So, who should actually buy these funds? They are primarily designed for retirees or those who need cash flow to cover living expenses. There is also a massive psychological benefit. Seeing that monthly payout can help you stay invested during market downturns. If you are deciding between them, remember the three main categories: systematic, active, and tax efficient. Go with QYLD if you want the absolute highest yield possible and don't care much about the share price growing. Choose JEPI if you want a professional team protecting your downside and keeping the share price more stable. And look at SPYI if you are investing in a regular brokerage account and want to minimize your tax liability. Lately, the industry has gone even further with single-stock income ETFs, like the ones targeting Tesla or Nvidia. These funds like NVDY or TSLY offer insane yields, sometimes over 50%, but the risk is extraordinarily high. If that one stock crashes, the income fund crashes with it. These are high-stakes trades, not long-term investments for most. For most people, a broad-based ETF like JEPI or SPYI is a much safer way to play the monthly income game. Don't forget the fees. These funds require complex management, so their expense ratios are higher than a simple index fund. While 0.35 or 0.60% might seem small, it adds up over decades. You are paying for the expertise and the monthly payout. What if you don't need the cash right now? Reinvesting those monthly dividends can lead to powerful compounding. By using a DRIP or dividend reinvestment plan, you turn your income machine into a growth engine. A final warning: never chase yield alone. A fund paying 50% is often a fund in trouble. Always look at the total return. The world of monthly paying ETFs is still evolving. New strategies are being engineered every single day. These funds are now available for almost every asset class, from international stocks to bonds and even cryptocurrencies. Some newer funds even apply covered call strategies to Bitcoin and Ethereum, offering massive yields with crypto-level volatility. Most advisors suggest using these funds as a satellite holding, perhaps 10 to 20% of your total portfolio. Keep your core in low-cost, broad index funds for long-term growth, and use monthly ETFs for your lifestyle needs. Whether you want to retire early or just have a little extra fun money every month, these funds offer a unique path. Let's recap the steps. First, decide if you want a systematic or actively managed approach to covered calls. Second, consider the tax implications. Are you in a tax-advantaged account like an IRA or a regular brokerage account? Third, always look past the yield at the total return. Ensure your principal investment isn't slowly disappearing. The derivatives market, once reserved for institutional pros, is now in the hands of everyday investors. That is the power of these ETFs. Remember that these funds perform differently in various market cycles. They are not set-it-and-forget-it growth plays. In a boring sideways market where everyone else is complaining, you'll be the one smiling with your monthly paycheck. In a bear market, the income can act as a buffer, reducing your total losses compared to a pure equity holding. As always, consider consulting with a financial advisor to see how these specialized tools fit into your specific life goals. Building a monthly income stream is a marathon, not a sprint. It takes patience, discipline, and the right tools. Consistency is the key to financial freedom, and monthly paying ETFs are perhaps the most consistent tools available today. Ignore the hype of 100% yields and focus on the high-quality, sustainable funds that have proven themselves. Think about where you want to be in 10 years. Will you have a portfolio that funds your lifestyle? It starts with one choice. Pay attention to ex-dividend dates. You must own the shares before these dates to receive the next monthly payment. When you combine high yields with the power of time, the results can be truly staggering. Don't underestimate the snowball effect. Protect your capital. Income is great, but preserving your original investment is the #1 rule of successful investing. The market is always changing, but the need for income is eternal. These ETFs are the bridge to that goal. Stay informed, keep learning, and adjust your strategy as the world of derivatives continues to expand. You now have the foundation to understand how these monthly paycheck machines actually work. Use them wisely. Income investing is more than just numbers on a screen. It's about the freedom to spend your time however you choose. Take the first step today. Research one of these funds, look at the prospectus, and decide if it's right for your journey. Remember, this is not financial advice. Always do your own research and consider your own risk tolerance before investing. Thanks for watching. Here's to your financial future and the steady income you deserve. Happy investing.